Into the macroeconomic view, recession odds. David Mericle, Goldman Sachs chief U.S. economist, joins us here. David, we watched your research team this week, I think on Wednesday, go from recession to not recession in one day. Many of the other investment banks kept their call. Why did you change it so sharply?
We moved our forecast to a recession when the country-specific additional components of the reciprocal tariff came on. That would have raised the U.S.'s effective tariff rate quite substantially. When those were taken away, we went back to a still high 45% probability of recession, but it's not anymore a base case. It's not just that the additional tariffs would have been very large, so that all of their effect is effectively a tax hike, the effect on business confidence and all of that is a little bit smaller now that the tariffs are smaller. It was also that a maximalist approach from the U.S. would probably have invited even more aggressive foreign retaliation, and that the tariffs were very large on some other regional Asian economies that Chinese trade has been rerouted through. So that large tariff on China would have had more impact if you can't just reroute, say, through Vietnam.
So now what we're left with is a bunch of other tariffs, but the biggie is the U.S. and China. How will that impact the U.S. economy if trade shuts down between the U.S. and China if these sky-high tariff rates stick?
Well, I would say actually it's quite a bit more than just the U.S.-China. We have a 10% floor on everybody else. We had a bunch of tariffs that were already in place, and we still think a large tariff on so-called critical imports is coming. All of this adds up to an increase in the U.S.'s tariff rate that we think will be 10 times at least what you saw during the 2019 trade war. So the U.S.-China tariff, by far the largest, I think that will shut down a fair amount, although not all trade flows between the two countries. If a consumer good that we import from China, if only a small, moderate share of the final consumer price actually consists of the import cost, then maybe some companies will still continue to do that. But with such a large tariff differential between China and other countries, I think we are effectively setting up a huge incentive for Chinese companies to ship goods through other countries, or to take advantage of production networks that they've established over the last 5-6 years that involve other countries where the finishing is done there. So that will be something that presumably the White House won't like, and we'll have to see how that gets resolved. But at the moment, there's a very large incentive to do that.
Are you guys on Fed intervention watch?
We are. We're still expecting under our 45% probability of recession forecast with 0.5% GDP growth this year, a modest uptick in the unemployment rate, about half a point. We think that would be commensurate with a package of 3 25 basis point insurance cuts. So we have those penciled in for June, July, and September. I think it's going to take a little bit of time before we get hard economic data that makes a case that things are getting worse. For example, we just got a payrolls report. The payrolls for April, being collected right now. I doubt we're seeing large layoffs right now. So the soonest we would see that's probably the May data in early June. In the meantime, the Fed's going to have to make a judgment call about our financial market conditions and the decline that we see. We just saw a moment ago in survey data, in the Michigan survey, for example, or in business surveys. Is that enough to justify a cut? It's possible, but we think more likely starting point would be June.
Half a point on the upside in the unemployment rate. So do you think that on the way there, the Fed decides that's clearance to do something?
I think that's right. I think with inflation high and inflation expectations now strikingly high, the bar to cut will certainly be higher than it was in 2019.
Well, inflation expectations in survey data, not necessarily in market
Absolutely.
pricing.
And Fed officials have taken some solace from that. And as we heard Chair Powell say at the March meeting, he's not that worried that this will become a persistent source of high inflation. So that if we do see the unemployment rate trending higher, I think they will feel at liberty to cut. I would say this raises the bar, but it's not prohibitive for cuts.
All right, David, thank you for joining us, bringing us up to speed on your views. David Mericle from Goldman Sachs.